And good morning to all of you wonderful melon heads. I hope you guys are well. Happy Friday, everybody. Today is May 5th, 2023, and the U.S. economy added 250,000 jobs in the month of April. The non-farms payrolls just came out a few moments ago. 250,000 jobs, a massive jobs beat. And CNBC is just gushing all the traditional finance press. They're fawning over, oh my goodness, this economy is just so strong. Oh, please don't get any stronger. No, I can't take it. Not mentioned in any of these glowing headlines, though, is the massive revision downward to the March and the February numbers. When you look at those revisions down, you're going to find that, oh, this jobs report, it kind of sucked. No, it didn't kind of suck. It really sucked. And this is a pattern we've seen all year. I don't know if you guys remember, it was about a month ago. I talked about this immense, massive revision to the jobless claims, the 4-week and the continuing numbers. It happened about a month ago. So, guys, this narrative of the strong jobs market, it's horse manure. It's not real. Look no further than real wage gains. For now, 25 consecutive months, we have had wages have risen less than the rate of inflation. And if we really had a tight labor market, labor would not be getting cheaper relative to goods and services. Labor would be getting more expensive. This jobs report, once again, does not pass the sniff test. That is not rain dripping down your back, folks. Sorry for the visuals. Elsewhere, we have got the 1-month Treasury just went bananas last night. And that is the bond market warning us we now have less than a month. And the Treasury General Account numbers will support that. The debt ceiling is rapidly approaching, and Congress is dragging their feet. And look, I've been saying it for a while. I know they're probably going to raise it at the last minute, but the possibility of a political accident is there. It is amateur hour in D.C. They think they've got more time than they really have. And if the banks keep going under, they're going to have even less. Luckily today, it looks like the banks are not going under today, at least for the moment. Most regional banks are bouncing big time right now. So we had some big sell-off in the regional banks yesterday. PacWest, Western Alliance, First Horizon, they're all up big this morning. Now, I would remind you, if you dropped 50% yesterday and you're up 50% today, you're still lower because you're up 50% from a lower starting point. So they're not exactly making back their gains, but at least for the moment, the bleeding in regional banks appears to be slowing. And with that, we're going to shrink my big melon of a head, and stocks are off to the races this morning. It is risk on. Why not? S&P 500 up 42 points at 4,103, up a full percent. The Dow, look at this monster run in the Dow right now, up 378 points or 1.15% at 33,506. And the NASDAQ up 1.05%, 123 points up at 12,090. So stocks are ripping higher this morning. U.S. dollar right now at 101.6, up about 19 basis points. It had a big step change earlier today. Still in that 101 to 102 range. The dollar is still trying to make up its mind where it wants to go. But this one right here, folks, check this out. This first line, I don't know if you guys can make this out, but the 1-month Treasury yield, 5.48%, up 93 basis points this morning. Almost a full percent step change in the 1-month Treasury. And a few minutes ago, a few hours ago, it was 5.73. All right, so look, the 1-month to the 3-month spread, we talked about that a lot. The 1-month to the 3-month spread, a few days ago, about a week and a half ago, the 3-month was yielding 175 basis points more than the 1-month. And right now, the 1-month is yielding 24 basis points more than the 3-month. That's a swing of almost 2%, 2 entire percent in the 1-month Treasury. The bond market is telling us the debt ceiling is coming fast. We had a 4-week Treasury bill, the 1-month Treasury auction yesterday, and the bond market is telling us they have no appetite for picking up 1-month pennies in front of the debt ceiling steamroller. That's what this is telling us right now. Massive step change in the 1-month Treasury. And why do you think that could be? Well, take a look at this, folks. This is the chart. This is the chart of the 1-month Treasury yield going back to about 2002. All right, so we are now firmly above even 2006, 2007 timeframe. All right, and by the way, the debt to GDP was significantly less the last time yields were anywhere up here. To say this is not sustainable is an understatement. But the reason that's really driving this, and I got to send a shout out to Lost Cosmonaut on my Discord server. Thank you very much, sir, for sending this one in. This is the daily Treasury statement. All right, comes out every day, gives us the balance in Uncle Sam's checking account. And here we go. There is $188 billion left in Uncle Sam's Treasury. But the big thing is yesterday, the government burned through $26 billion of cash. They burned through $26 billion yesterday. They have $188 billion left. They burned through about 20 the day before that. And then 3 days ago, they burned through $78 billion. So at the rate the government is burning cash right now, this Treasury General account, we won't even make it to June 1st. And that's why you're seeing nobody is going to buy a bond that matures after June 1st at this point. Nobody's touching it, demanding a much higher yield. The price is falling, the yield is rising. So the debt ceiling cometh. It's getting here fast, folks. It's getting here faster than Congress realizes it. And $188 billion, burning down a rate of 25 to 78 billion a day. You do the math. How much time do we have? A whole lot less than they're telling us. So pay attention to that one, folks. The debt ceiling is going to be a major issue very soon. They'll probably get it done, but there's the likelihood of them not getting it done is increasing, in my opinion. Over in the commodity space, we've got gold is getting smashed a little bit this morning. Again, it's risk off. I don't get it, but that's what it is. Gold is at 2015, down about $40 or almost 2% today. Still over that $2,000 number. And silver also getting smashed down 2.5% or 66 cents at 25.56. We got oil is taking a break from the sell-off today at 71.22, up $2.64. Natural gas even in on this one at $2.13, up about 3 pennies. But here's the big story this morning. Here's the one everybody's talking about. Job growth totals 253,000 in April, beating expectations even as the U.S. economy slows. And this is actually a big step for you, CNBC. Let me just congratulate the journalists with all the integrity over at CNBC for actually admitting, finally, that the U.S. economy is slowing. My God, I mean, this feels like a big win here, folks. U.S. economy slows. When does CNBC ever admit that? So besides that, the rest of this article is pure horse manure. Let me get through it, and then I'll tell you why. Job growth fared better than expected in April. Despite bank turmoil and a decelerating economy, the Labor Department reported non-farm payrolls increased by 253,000, beating estimates for 180,000, according to the Bureau of Labor Statistics. Estimates of 180, it came in at 253. Wow, that looks like a big beat, right? A 73,000 job beat on the headline. But wait, there's more. The unemployment rate was 3.4% against an estimate for 3.6%. And tied for the lowest since 1969. Man, that jobs market is hot. Average hourly earnings, a key inflation barometer, rose 0.5% for the month. That's actually pretty good, more than the 0.3 estimate. On an annual basis, wages increased 4.4%, higher than expected of a 4.2% gain. But I might add that 4.4% year-over-year gain, still lower than the rate of inflation. So the average working stiff in this country is still getting poorer. The dollar is losing its value faster than he can earn it. Now, here's one of the things. This is on Trading Economics, talking about the non-farm payrolls report. And here, forget everything else in this report. This one sentence should set off alarm bells, should make the hair stick up on the back of your neck. They're saying employment also increased in financial activities by 23,000 jobs in the month of April. Do you honestly think, step back from everything for a second, folks. Does this pass the sniff test to you? We had the second and third largest bank failures in history in the month of March. The carnage continued through April. It didn't get so bad, but it was still there, right? Banks didn't fail in April, but they were continued to be under stress. Do you honestly think financial activities added 23,000 jobs in the month of April? I mean, right there, that is just, I'm sorry, it is not a believable number. I do not believe that 23,000 jobs were added in finance last month, not with headlines of job losses and branches shutting down and layoffs in mortgage departments. It just does not pass the sniff test, folks. And then here we go. Walter Bloomberg. Thank you very much, sir, for this one. This is where people should go first. All right, to something like this. I mean, you don't get accurate information from the financial press anymore. You get information through the filter of the narrative they want to push. And you have to go to Walter Bloomberg on Twitter to get that. Here we go. U.S. April non-farm payrolls, plus 253,000 when the consensus was plus 180. So there's the beat, the 73,000 jobs beat. However, the March jobs number was previously reported at 236,000. They revised that down to 165,000. So the March number got revised down by 98,000 jobs. Not mentioned anywhere in that CNBC article that I just read you. No mention of it. The February number, previously reported at 326,000, was revised down to 248,000. That's a decline of 78,000 jobs. No mention of that anywhere in the CNBC article. If you count the two revisions combined, there was a loss of 176,000 jobs in the revisions to the two prior months. So if you subtract that 176,000 in revisions to prior months from this amazing headline, the 253,000 that everybody's just gushing over in the financial press, subtract those revisions, you're only left with 73,000 jobs added in the month of April. And that is only about a third of population growth in the U.S., which means the U.S. economy is not really growing. It's not really adding jobs. No mention of that anywhere in CNBC. All right. So if you subtract the 176,000 jobs lost in the form of revisions to the two prior months, then this is actually a miss of 103,000 jobs, not a beat by 73,000. Where's the mention in CNBC? Where's the mention in Bloomberg? They're not talking about this. David Faber is on CNBC right now saying, oh my God, it's clearly, we shouldn't be shorting bank stocks. And oh my God, the economy is so good, we're adding jobs. Build back better, all that. No mention of it. No mention of it anywhere. And we've seen this over and over again. Inflate the number, get the gushing headlines, brag about it in a press conference, and then a month later, quietly revise the numbers down to the point where it says something totally different, but don't mention it. Again, that is not rain that is dripping down your back, folks. The strong jobs market. And you wonder why we see 25 consecutive months of negative real wage gains, because the job market is not strong. It's just not. And again, 23 when they're telling you 23,000 jobs were added in financial activities right away. I mean, if you're going to try to tell me that, if you're going to make this stuff up as you go, at least make it believable. That is on its face absurd. 23,000 jobs added in finance while banks are failing. It just, you got to start from a position of grounded in reality if you're going to lie to me. At least make it believable. All right, PacWest leading regional bank rebound after a bruising rout. This one's going on this morning. PacWest shares rally after sliding almost 70% this week. The KBW Bank Index has lost 11% this week as big lenders are hit. And no, I didn't have it once. Let's see. PacWest Bancorp led a rebound across U.S. regional bank stocks after a bruising week of losses, joining in the broader rally across U.S. stock futures ahead of jobs data due later today. This one's a few hours old. PacWest shares gained as much as 26% in U.S. pre-market trading on Friday, while peers Western Alliance and First Horizon rose 15% and 7%. The investor panic around regional banks started in March with fears of a few lenders that had big unrealized losses on bond investments or large proportions, yada, yada. You know all about that. And let's see what's going on in some of these bank stocks this morning. We've got PacWest is up 56%. Why? Yikes. PacWest is doing all right today. Still below the starting point of yesterday, but looking much better over at PacWest than yesterday. Western Alliance is up 37% this morning at $25. First Horizon, the one that was set to merge with TD, but TD canceled that merger, up 5.5% this morning, also looking pretty good. And the Spider Regional Bank ETF is up 5.7% this morning. So things are looking a lot better in the regional banks this morning. They were due for a bounce after the bloodletting that we've seen in the last few days. We'll see if this one holds, though. Something tells me it's not over. Again, we just hiked rates again, And the reason why all of these banks are dropping is because of unrealized losses on their balance sheets. Things like commercial real estate, U.S. treasuries, mortgage-backed securities are not worth anywhere near what the banks are claiming they're worth on their balance sheets. So if people come to withdraw their money, the bank may not have it if enough people do that. Most regional banks in the U.S. are insolvent at this point. All right, guys, I just want to say thank you very much to everybody who is watching today at home. Thank you very much to my Patreon supporters. Thank you for the Bureau of Labor Statistics for the very entertaining narrative for this wonderful work of fiction that was the non-farm payrolls report this morning. Might want to lead with those big revisions next time. CNBC, you might want to include those big revisions the next time you cover this, because the revisions alone were bigger than the beat. This was a massive jobs miss if you look at the narrative as a whole. And watch that 1 month Treasury, folks. The 1 month is warning us the debt ceiling is not a done deal. Nobody wants to pick up those 1 month pennies in front of that debt ceiling steamroller, folks. And, we're down to a couple of days, just a couple of days. At the rate we're burning through cash, 20, 25 billion, 78 billion a few days ago, the Treasury General account will run dry before Congress gets this deal done. Unless there's something that they're not telling us in Congress, unless they're like minutes or hours away from a deal for the debt ceiling and they're not telling us that. Maybe they are. But for me, I remain very skeptical right now. There is a non-zero chance of an accident happening here. And just be careful out there, folks. All right. Thank you very much to my Patreon supporters for everything you do for the channel. Link down below should you feel so inclined. I'll see you guys this afternoon for my weekly wrap-up live stream at 3:15 p.m. Eastern Time. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.